Hi everyone, and welcome to the first video on the Whale Watchers channel. In this first module, we're going to build the most important foundation for any trader, understanding how to read price charts. We'll cover what those little red and green bars mean, introduce you to the world of Japanese candlesticks, and then explain why, for our specific strategy, we'll be using something a little different. Let's get started. When you first look at the trading chart, you'll most likely see Japanese candlesticks. They are the most popular way to visualize price movement, and for good reason. Each candle tells you a story about what happened in a specific time frame. Let's break it down and let's have a look. Every candle has four key pieces of data. The body, this is a thick part that shows you the range between open and the close price. If the candle is green, the price closed higher than it opened, and that's a bullish sign. If it is red, the price closed lower than it opened, and it is a bearish sign. The wicks. These are the thin lines above and below the body. They show you the absolute high and low prices the asset reached during that period. The shape and the size of these candles can give us clues about market sentiment. For example, a Marubozu candle with no wicks shows extreme conviction, while a spinning top or a doji shows indecision in the market. There are many types like the dragonfly and gravestone doji, which can signal potential reversals. Now, candlesticks are fantastic, but for the strategy we're going for, we'll have to focus on something a little cleaner, the bar chart. A bar chart shows the exact same four pieces of data, the open, high, low, and close, but in a simpler way. The vertical line is the high to low range. The small tick on the left is the open, and the tick on the right is the close. And depending on the level where the open and close happened, we can expect a bearish bar, which is red on the left you can see, or the bullish green bar you see on the right hand side. And the rules of opening and closing is exactly the same you will see in a Japanese candlestick. So why do we prefer this? Our trading strategy is built around identifying key support and resistance levels. We need to see exactly how price behaves at these specific levels. Bar charts give us a cleaner, less noisy view of this price action, which helps us pinpoint our entry points with greater precision. Finally, no chart analysis is complete without understanding time frames. A chart can represent minutes, hours, days, or even months. To trade effectively, you need to look at all of them. Daily, weekly, and monthly charts represented by DWM. We use these to spot the major global trends in the market, and we can ask questions. Is the market generally moving up, down, or sideways over the long term? Hourly charts represented by H1 to H4. These help us to identify the local trends within the bigger picture. And the minute charts in the form of 5, 15, 30 minutes. This is where the actual work happens. We use the shorter time frames to find our precise entry points once the price reaches our key support or resistance level.